For years, the crypto landscape was dominated by the chaotic energy of speculative meme coins, where fortunes were built on hype and destroyed in seconds. However, the tide is finally turning. Smart money is no longer satisfied with digital air. They are seeking the stability and predictability of real-world assets. Imagine a market where your portfolio isn't just a collection of internet jokes, but a diversified basket of income-generating properties and government debt. This fundamental shift marks the end of pure speculation and the beginning of the utility era. We are witnessing the professionalization of decentralized finance, where institutional-grade assets are being brought on-chain to provide sustainable, low-risk passive income. The institutional awakening is here, and it is reshaping everything we know about liquidity. Major financial titans, once skeptical of blockchain, are now racing to tokenize trillions of dollars in traditional assets. Why? Because the legacy financial system is slow, expensive, and fragmented. By moving these assets onto a transparent ledger, we eliminate the middlemen who have historically drained profits through excessive fees. This isn't just a trend, it's a structural migration. We are seeing a mass exodus from high-volatility, low-utility tokens toward assets that offer real-world cash flow. The market is now punishing empty promises and rewarding protocols that offer tangible, verifiable value. As global interest rates fluctuate, the search for stable yield has led investors back to the safety of government bonds and commercial real estate. But historically, these markets were gated by high entry barriers and complex legal hurdles. RWA tokenization shatters these walls, allowing anyone with an internet connection to participate in wealth creation strategies previously reserved for the elite. We are entering a phase of the flight to quality. Investors are moving away from the pump and dump cycles of the past and toward assets that provide quarterly dividends and steady appreciation. This transition is creating a new standard for decentralized finance, where the underlying value is anchored in the global economy rather than social media trends. To understand this revolution, we must deconstruct how a physical skyscraper, or a massive gold reserve, becomes a digital token. It begins with the creation of a special purpose vehicle, a legal entity that holds the title to the asset. This bridge connects the physical world to the blockchain. The asset's value and legal rights are then encoded into a smart contract, which governs how ownership is transferred and how revenue is distributed. This process, known as minting, creates a digital twin of the physical asset. Each token represents a proportional share of the underlying value, allowing for granular ownership. This technical breakthrough enables 24/7 trading of assets that were once illiquid, and compliance is the bedrock of the RWA boom. Unlike the Wild West era of crypto, these protocols operate within strict regulatory frameworks. Every investor undergoes rigorous identity verification, ensuring that the ecosystem remains clean and institutional ready. This legal layer is what gives smart money the confidence to deploy billions. By automating compliance through programmable tokens, we ensure that every transaction adheres to international law without needing a small army of lawyers. This automation reduces administrative overhead, allowing more yield to flow directly to the token holders. The marriage of legal certainty and cryptographic proof is creating a new trust layer that the traditional financial system simply cannot match in terms of speed or cost efficiency. Let's look at fractional ownership in action. Imagine a $50 million commercial office building in Manhattan. Historically, only a handful of billionaires could own such an asset. Through tokenization, that building is divided into 5 million tokens, each worth $10. This democratizes real estate, allowing a retail investor to earn a pro-rata share of the monthly rent and any long-term capital appreciation. The blockchain serves as the ultimate ledger of truth, recording every change in ownership instantly and transparently. No more title insurance headaches or delayed closings. The result is a more efficient market, where liquidity is high and the barrier to entry is virtually non-existent. Changing beyond property, the migration of sovereign debt on-chain is perhaps the most significant development this year. Treasury bills, often called the risk-free rate, are now accessible as liquid tokens. These RWA protocols act as distribution engines, funneling the yield from traditional finance directly into the pockets of DeFi users. This creates a powerful synergy, the security of the US government combined with the speed and composability of blockchain technology. Investors can now use their tokenized treasuries as collateral in other decentralized protocols, further amplifying their capital efficiency. This integration of traditional yield into the crypto ecosystem provides a stable foundation, allowing for more complex financial products to. The battle for RWA dominance is currently being fought across different blockchain networks. While Ethereum remains the primary hub due to its massive liquidity and established security, new competitors are emerging. Specialized chains are being designed specifically for regulated assets, offering built-in identity layers and superior transaction throughput. These institutional-grade blockchains prioritize compliance over total decentralization, creating a safe harbor for banks and asset managers. We are seeing a fierce competition between general-purpose networks and niche protocols. The winner will be the ecosystem that offers the best balance of security, speed, and regulatory compatibility. This infrastructure race is crucial as it determines which platform will. Leading the charge are heavyweights like BlackRock with their BUIDL fund and protocols like Ondo Finance and Centrifuge. These entities are not just building software, they are building the plumbing for the future of global finance. BlackRock's entry into the space signaled a point of no return, validating the entire RWA sector in the eyes of traditional institutions. Meanwhile, protocols like Centrifuge are connecting real-world businesses with on-chain liquidity, allowing companies to borrow against their invoices or real estate. These partnerships are bridging the gap between the trillion-dollar private credit markets and the burgeoning crypto economy. The collaboration between legacy giants and native crypto protocols is creating a robust hybrid financial system that leverages the best of both. Interoperability is the final piece of the puzzle. For the RWA ecosystem to reach its full potential, these tokenized assets must be able to move seamlessly across different blockchains. Cross-chain communication protocols are being developed to ensure that a tokenized bond on one network can be used as collateral on another. This creates a unified global liquidity pool, breaking down the silos that have traditionally isolated different financial markets. As these networks become more connected, the utility of tokenized assets grows exponentially. An investor can hold real estate in London, use it as collateral for a loan in Singapore, and earn yield on a New York Treasury bill, all within a single digital interface. However, we must address the reality of the risks involved. While the potential is massive, the technology is still maturing. Smart contract vulnerabilities remain a persistent threat, and the failure of an oracle, the data feed that reports real-world prices, could lead to liquidation cascades. Furthermore, the regulatory landscape is still shifting, and sudden policy changes could impact the liquidity of certain assets. Investors must also consider lockup periods, where their capital may be inaccessible for fixed durations. Regulatory compliance, while a benefit, also means that your assets could be frozen by authorities if legal issues arise. A reality check is essential. High yields are never truly free of risk, and thorough due diligence. As we look toward the horizon, the RWA boom is more than just a passing trend. It is the maturation of the entire blockchain industry. The transition from speculative play money to institutional-grade, yield-bearing assets marks the final stage of crypto's evolution into a legitimate asset class. For the patient investor, this represents an unprecedented opportunity to capture stable passive income while participating in the efficiency gains of a technological revolution. The road ahead will be defined by further integration with traditional finance, improved security standards, and widespread adoption. The question is no longer if real-world assets will move on-chain, but how quickly you will adopt to this new era of wealth management. The revolution has just begun.